Good morning. Subcommittee on Digital Assets, Financial Technology, and Inclusion will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Decoding DeFi, Breaking Down the Future of Decentralized Finance. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for an opening statement. Welcome back, members and staff, to Capitol Hill following our August work period. Today we're going to discuss decentralized finance. After the FIT21 legislation passed with broad bipartisan support, I wanted this subcommittee to explore emerging topics like tokenization and DeFi. As we consider how blockchains can be used in finance, we must continue expanding our knowledge of the possible costs and benefits as it relates to DeFi. Decentralized finance envisions a financial system that's permissionless, transparent, efficient, and built on top of blockchain networks. It's based on the fundamental idea that individuals should have the freedom to transact without the fear of illegal financial surveillance or abuse by governments. By substituting intermediaries for autonomous, self-executing code, decentralized finance can shift the way the financial markets and transactions are currently structured and governed. A peer-to-peer future where a Canadian Prime Minister in the future can't freeze your bank account just for going to a protest. But whether it's artificial intelligence or digital assets, we cannot legislate thoughtfully or do oversight of the regulatory agencies if we don't understand it. And DeFi is not only complex, but cutting edge, changing, and a completely different way of working. But at the end of the day, decentralized finance is not a person or a company, it's a technology, and one that connects people together to reimagine how we transact with one another. So today's hearing is designed to take a deep dive into some core concepts behind DeFi. I'd like members on both sides of the aisle to approach it with an open mind. We'll hear from our witnesses about this technology, how it works, the potential benefits and risks, the legal and regulatory implications. It's important to remember that our regulatory and legal frameworks were designed for a financial system with centralized intermediaries. It doesn't contemplate the decentralized peer-to-peer ecosystem made possible with digital assets and blockchains. That's why jurisdictions like the European Union have chosen to explicitly carve out DeFi in their digital asset legislation so they can continue to better understand it. Rightfully, we took the same approach in drafting our FIT21 legislation here in the House, which directed the Treasury, the SEC, and the CFTC to study this issue together and report back to Congress on the implications and their recommendations. Contrast that with the Biden-Harris administration, which uses rulemaking and enforcement actions to go after DeFi and threaten its existence and the future of its use in the United States. Now that this committee has moved with our historic bipartisan FIT21 legislation, it's important that together we assess DeFi and study the most effective way forward. This hearing is not just about smart contracts and decentralized protocols. It's about how decentralized peer-to-peer technology can preserve individual freedom and improve our financial services for business and consumers alike. Together, we'll take another step in our work on the regulatory landscape that supports transformative technology. I encourage everyone on the subcommittee to engage in an informed, open-minded dialogue with our esteemed witnesses today to better understand how Congress can help Americans assess and leverage this technology in a safe and secure manner. I'm grateful to our witnesses and on our panel today and sharing their wealth of knowledge, and I look forward to the discussion. Now let me yield to the ranking member for some opening comments.
Good morning. Thank you, Mr. Chairman, for hosting this hearing, and I want to thank our witnesses in advance for their willingness to help the committee with its work. This hearing aims to explore the future of decentralized finance services, or DeFi. DeFi generally refers to virtual asset protocols and services that allow for automated peer-to-peer transactions by using blockchain technology. Unfortunately, there's no consensus definition of DeFi among regulators or industry, which makes this a difficult sector to assess. DeFi providers claim to offer permissionless and interoperable payments, allowing for efficiency and anonymity. However, it has become increasingly evident that these features have made DeFi most attractive to illicit actors who seek to conduct illegal activity. Bad actors continue to develop the techniques that conceal the origins of crypto funds, such as chain hopping and using anonymity-enhanced cryptocurrencies. A risk assessment report recently issued by the Treasury found that cyber criminals, scammers, and ransomware actors take full advantage of DeFi vulnerabilities to launder illicit proceeds. Additionally, the lack of compliance with anti-money laundering and terrorist financing laws by DeFi players make this space even more susceptible to illegal activity. To be clear, we do have consensus in the need for faster payments, anonymity, and privacy. These goals can be achieved in legal and safe ways through policy change. I continue to champion the eCash Act, which directs the Treasury to explore privacy-preserving technology that facilitates permissionless, interoperable, and instant payments. I am also encouraged by the Fed's progress in achieving a real-time payment system. I hope to see more projects that explore innovations such as Project Hamilton, which was led by the Boston Fed and MIT. The digital assets industry has had episodes of implosion and a continuous stream of enforcement actions and a drumbeat of reports of scams, money laundering, demonstrating why it will only survive through proper legislation. The crypto lobby continues its pursuit of becoming exempt from basic investor and consumer protections and national securities laws. The growing presence of the digital assets industry in this election cycle speaks to its growing desperation to remain unregulated. This committee should have explored digital asset topics such as DeFi and tokenization long before legislation was introduced. The FIT Act, which I strongly opposed, excluded DeFi services, and I urge this committee to refrain from moving forward with similar legislation that would invite the same consumer and investor protection risks by legitimizing this industry. The DeFi and digital assets industry has proved that it cannot be trusted to offer what it claims. Instead, we should be exploring policy changes that modernize our payments and banking system and encourage safe innovation. I want to thank the witnesses for their willingness to appear and help the committee with its work. I look forward to our exchange of ideas, and I yield back.
Gentleman yields back. Today we welcome the testimony of Brian Avello. Mr. Avello is the Chief Legal Officer of UDHC, an investment fund focused on DeFi's ecosystem. Rebecca Rettig. Ms. Rettig is the Chief Legal and Policy Officer at Polygon Labs. Amanda Tuminelli. Ms. Tuminelli is the Chief Legal Officer of the DeFi Education Fund, an advocacy and education organization focused on DeFi policy. Peter Van Valkenburgh. Mr. Van Valkenburgh is the Director of Research at Coin Center, a research and advocacy group focused on the public policy issues facing digital asset technologies. And Mark Hayes. Mark Hayes is the Senior Policy Analyst on FinTech with Americans for Financial Reform. Each of you will have 5 minutes for your oral remarks. Your whole statements will be put in the record. And Mr. Avello, we recognize you for 5 minutes.
Before I begin, a brief disclaimer. I'm here today in my personal capacity, and the views and opinions I express are my own and do not reflect the views or opinions of my employer, my colleagues, any of our portfolio companies, or any projects with which I serve as a non-executive director. Thank you for the opportunity to speak today. My name is Brian C. Avello, and I'm the Chief Legal Officer for the Universal DeFi Holding Company, a principal investment firm. I've been an attorney in the cryptocurrency space since 2016, and my experiences as outside counsel and general counsel have shaped my understanding of decentralized finance, or DeFi, and its growing significance in our financial ecosystem. DeFi has evolved rapidly since the early days of 2017 and 2018. My journey here began in earnest as the general counsel for the Maker Ecosystem Growth Foundation, a now dissolved software company that worked with its industry partners to bring the leading credit generation platform, MakerDAO, or known as Maker, and decentralized stablecoin, multi-collateral DAI, to market in November 2019. Some would say that Maker was the world's first DeFi project. I also have had the privilege of investing in various startups that bridge DeFi and centralized finance, or CeFi. These experiences have led me to believe that a thoughtful regulatory framework is essential for DeFi to fully integrate with traditional financial systems. DeFi at its heart is an open source technology movement that encompasses a broad spectrum of products that operate outside of centralized financial institutions. They are built on public, permissionless blockchains like Ethereum and encompass various business models, focusing primarily on borrowing and lending in decentralized exchange, and now real-world assets, or RWAs. And most importantly, DeFi projects are open protocols, meaning anyone can use them to build new and innovative products, from Citibank using a lending protocol to greatly expand their client accounts, to a single developer building a product competitive to established financial institutions. At present, the leading DeFi applications range from borrowing and lending protocols that allow users to lend their crypto assets in exchange for returns, to decentralized exchanges that facilitate peer-to-peer trading through automated market makers. Moreover, RWAs have recently come to the fore. These are on-chain representations of off-chain assets that provide users access to either interest-bearing opportunities or alternative assets, as well as near real-time execution and settlement and easily verifiable accounting. They can include government securities, corporate credit, and tokenized funds, and allow accredited and institutional investors to access various sources of yield on-chain. One significant issue is the regulatory landscape surrounding DeFi. Many users are underinformed about the complexities of DeFi protocols, and the absence of traditional intermediaries complicates compliance. For instance, most, if not all, current financial regulations assume the existence of intermediaries like banks, brokers, and investment advisors, which can be difficult to square with decentralized systems built on peer-to-peer and peer-to-protocol transactions. Addressing these challenges is hard, but not impossible by focusing at first on enhancing consumer protections through mandatory disclosures. These should include clear explanations of the technology, detailed information on token distributions, and transparency regarding governance. But please note that I do not view simple disclosure as a cure-all for DeFi's issues or an end-around from other ideas for regulation. Rather, I believe it is the initial step of many before we arrive at DeFi sufficiently regulated and integrated into our financial systems. Indeed, a multi-agency regulatory framework could ensure users are 1, fully informed about the protocols they access, and 2, protected from malicious actors, while permitting developers and user communities to compliantly innovate and scale this promising technology here in the United States. In sum, DeFi has shown remarkable growth and potential since its inception, and I hope that my practical experiences can contribute to a better understanding of how these markets are developing, while communicating the base idea that however lawmakers arrive at regulating DeFi, they focus on disclosure and consumer protection is paramount. Thank you.
Thank you, sir. Ms. Rettig, you're recognized for 5 minutes. Thank you.
Good morning, Chairman Hill, Ranking Member Lynch, Chair McHenry, and members of the subcommittee. Thank you for the opportunity to testify. I've spent the last 7+ years of my legal career representing software developers building novel blockchain-based technology, including DeFi applications. I brought to this work years of experience at a large New York law firm where I represented Fortune 500 companies and traditional financial services firms in securities and other regulatory matters, and where I experienced the intersection of law and technology firsthand in one of the early peer-to-peer file sharing cases. Currently, I'm the Chief Legal and Policy Officer of Polygon Labs, an international software development company building blockchain technology. Today, I'll discuss how the unique mechanics of DeFi have informed the global regulatory response to this technology and briefly touch on a policy proposal to treat DeFi as critical infrastructure to maximize user and market protection. Decentralized finance refers to a software system that allows users to engage independently in financial transactions. It's part of the larger Web3 movement that returns the internet to individuals, a response to consumer demand for peer-to-peer transparent networks, for increased competition, and for control over one's own data. This means no big tech company and no big finance firm sits in the middle of any DeFi transaction. The hallmark of DeFi is that users retain custody and control over their assets and their data at all times. DeFi protocols are a set of automated code-based rules that allow for financial transactions when users provide the instructions. These are similar to the software protocols like TCP/IP that underlie our internet today. Code for DeFi protocols is open, can be reviewed in real time, and audited by anyone. There's no proprietary black box as in the traditional financial world. This increases predictability for users, and these open systems increase competition to build better user experiences. DeFi protocols are built on public infrastructure, namely blockchain networks. DeFi transactions are cryptographically settled on these networks via automated consensus of thousands of computers, which creates a transparent record of transaction data. Like the internet itself, this infrastructure can be accessed and utilized by anyone with an internet connection. The term infrastructure usually evokes the idea of roads and bridges. Today, it's also the technological systems that underpin many industries, from aviation to farming to financial services. In the United States, that infrastructure is overseen by CISA, the Cybersecurity and Information Security Agency, as critical infrastructure in collaboration with various other agencies, including the Treasury Department and law enforcement. DeFi can likewise fall under their purview. Today, DeFi allows users to exchange one crypto asset for another, provide crypto asset liquidity for borrowing, or engage in novel trading strategies. Yet DeFi remains nascent. The first DeFi protocol is approximately 7 years old, and today DeFi holds around $78.9 billion of crypto asset value. This is only 3.9% of total crypto value and 0.07% of global GDP. Because DeFi systems are neutral technology, regulators have recognized that we can't perfectly map traditional financial laws onto intermediary-less systems. The IMF and the Financial Stability Board recognize that, quote, in the case of DeFi, the lack of intermediaries means that the traditional approach to regulation cannot be applied. The UK's HM Treasury agreed, stating that regulation of DeFi, if any, would occur after any centralized crypto regulation. The same is true for EU, Japanese, Singaporean, and UAE regulators, all of whom have implemented centralized crypto regulation, but not DeFi regulation to date. In fact, the EU's markets and crypto asset regulation specifically exempts services performed in a fully decentralized manner without intermediaries and requires a study of DeFi. Other regulators around the globe have devoted time and resources to analyzing novel DeFi use cases, including the Bank of International Settlements, various central banks, and the Singapore Monetary Authority, who have all experimented themselves with DeFi technology. DeFi addresses many of the core policy considerations of traditional financial services in a different way, through automation, transparency, and user control over assets and data. And many of the risks in DeFi can be addressed by treating it as critical infrastructure. This is the topic of a recent paper I co-authored examining how CISA, in collaboration with OSIP, Treasury's Office of Cybersecurity and Critical Infrastructure Protection, can work to mitigate cyber and system management risks to bring about policies that protect both users and markets, a mission fundamental to the long-term growth of DeFi. I'm appreciative of the subcommittee's efforts to understand this technology, and I look forward to your questions.
I thank for your testimony. Mr. Tuminelli, you're recognized for 5 minutes to give your oral remarks.
Thank you to the subcommittee for holding this hearing. My name is Amanda Tuminelli, and I'm the Chief Legal Officer at the DeFi Education Fund, a nonprofit, nonpartisan group that educates lawmakers and the public about decentralized finance and advocates for sound DeFi policy. We believe that DeFi is the path to a more equitable and more efficient financial system, one in which people have access to finance regardless of where in the world they live and regardless of the merits of their application. I will leave you with 2 points today. First, DeFi is different from and an improvement upon traditional finance because it does not rely on intermediaries. And second, the existing approach of demanding that DeFi look like, function like, or be treated like traditional finance has not and will not work. So what is DeFi and how is it different? As others have said today, DeFi enables peer-to-peer transactions in which users self-custody their assets, just like with cash. Using DeFi, a person can trade assets, make and take loans, or earn interest, but it is improvement on the current system in a number of ways. For example, TradFi relies on intermediaries that often serve as gatekeepers to finance. Traditional financial institutions like big banks can and do deny access to the system for discriminatory reasons or no reasons. But DeFi is open access. Anyone with an internet connection has access to a DeFi protocol, and that is the epitome of financial inclusion. TradFi is expensive to access and slow to use. Even the simple act of sending money usually requires paying fees to third parties and waiting days for a transaction to be approved or processed. But using DeFi, I can send money or execute far more complicated transactions anywhere in the world, 24/7, with nearly instant settlement. And as one last example, DeFi is better because it's self-custodial. As this committee knows, when TradFi services fail, customers lose access to their assets. But in DeFi, there is no fear of losing access to your money in a bank crisis because assets in your self-hosted wallet are always available to you. So that brings me to my second point. The existing approach of trying to apply rules for TradFi to DeFi will not work. The traditional financial system requires intermediaries to function. Brokers effect stock trades and clearinghouses settle transactions. And that means that we need to trust intermediaries to do their jobs reliably and honestly. And the existing rules evolve to prevent the abuse of our trust. But DeFi doesn't use intermediaries. If I want to swap two digital assets using a DeFi protocol, there is no broker and there is no clearinghouse. DeFi's existence, the very reason that this technology was developed, was to eliminate the need to rely on intermediaries and empower people to transact directly with their peers. Existing law assumes that there is some identifiable entity that can take possession of my funds, collect information about my transaction, and even block a trade. But that entity does not exist in DeFi. The untenable position between the law as it stands and the reality of DeFi technology has led to an increasing amount of regulatory uncertainty. Seasoned lawyers with decades of regulatory experience cannot give their clients advice with certainty about whether their projects comply with the law. That's why judges in multiple district courts across this country have called on Congress to make new rules regarding digital assets. And this chamber has supported bipartisan efforts and signaled that the status quo is not working for DeFi and digital assets. The existing approach of trying and failing to apply existing rules to this technology has led to so much hostility to innovation that American jobs and businesses have been heading overseas. But the vast majority of DeFi developers are smart, creative people with a vision of building a better financial system, and they want to do that legally. So the US can be at the forefront of that and create a clear path to building here, or we can let other countries pass us on the path towards our digital financial future. But if you care about national security and you care about economic development, then you want this industry here on US soil. We appreciate the efforts of members of Congress, such as those on this committee, who have engaged with us on the reality of the technology and engaged with us on a path forward. Thank you.
Thank you very much. Mr. Van Valkenburgh, you're recognized for 5 minutes.
Chairman Hill, Ranking Member Lynch, Chair McHenry, members of the subcommittee, thank you for this opportunity to testify at today's hearing. So in the 1940s, there were 350,000 telephone switchboard operators in the United States. Privacy-conscious Americans worried that operators might still be listening to their calls after connection, and their fears were not unfounded. In the 1928 Supreme Court decision Olmstead v. U.S., wiretapping was deemed not to violate the Fourth Amendment. This allowed police to listen into calls and conversations without any proof of reasonable suspicion or judicial oversight, and to use that evidence against those Americans in court. By the end of the 20th century, two significant changes had occurred. In 1967, the court overturned Olmstead in the landmark decision Katz v. U.S., and by the 1980s, computers and automation had largely replaced human telephone operators. By the end of the 20th century, those changes had occurred. Today, there are around 600,000 licensed stockbrokers in the US, fewer brokers per person than telephone operators in the 1940s. Like the operators of the past, financial middlemen can and do learn the intimate details of our lives. But in the 1976 decision Miller versus US, the Supreme Court ruled that Americans have no reasonable expectation of privacy in the financial records they keep with third parties. Fortunately, now in the 21st century, two things are changing once again. First, many financial transactions no longer require a human intermediary, a concept known as DeFi. Second, the court is poised to overrule Miller and vindicate privacy rights just as it did with Olmstead. There's a pattern here that's hopefully clear. Initially, we have privacy in our day-to-day affairs, but we have to do things in person, a cash transaction or a face-to-face conversation. Then technologies emerge that scale human action across vast distances, but we lose our privacy in the process, a telephone call, a bank wire. Finally, technologies improve, restoring privacy without sacrificing scale, and the law catches up to protect citizens' expectations of privacy. We get encrypted messaging, we get Bitcoin transactions. In the past, American dynamism and constitutional law drove these changes, but it's not inevitable that America will always lead this revolution. If we don't allow Americans to use and develop peer-to-peer financial systems, those tools will be used and developed overseas. Insisting on re-intermediating and surveilling peer-to-peer financial transactions would make the US as non-competitive as a country still relying on human switchboard operators for telephone calls. Nonetheless, the IRS is drafting rules that would force unhosted wallet software developers to go into the business of monitoring the users of their software, re-intermediation. The Department of Justice is prosecuting mere software publishers as unlicensed money transmitters. The Office of Foreign Asset Control, OFAC, has banned Americans from using certain DeFi software tools even for entirely domestic and legitimate purposes. The Securities Exchange Commission is using enforcement actions to fit cryptocurrency activities into traditional regulatory frameworks that require intermediaries. These agencies pursue these regressive strategies without clear congressional direction. The IRS is contradicting the plain language of the Infrastructure Act. The Southern District of New York is offering unjustified interpretations of the Bank Secrecy Act. The SEC is stretching its jurisdiction through overzealous enforcement and an unconstitutional rulemaking. Congress has a pivotal role to play in preserving American dynamism. Some members have already begun to push back. The Blockchain Regulatory Certainty Act, the Keep Your Coins Act, and FIT 21 would clarify the legal landscape and leave room for innovation. My organization, Coin Center, is also dedicated to preserving American dynamism. We're here to educate members of Congress and the executive branch about these technologies, advocate for reasonable regulation, and preserve constitutional rights, as we are doing through two challenges to regulatory overreach that we've brought in the courts. I appreciate the committee's time today, and I look forward to addressing any of your questions.
Thank you, sir. Mr. Hayes, you're now recognized for 5 minutes for your oral remarks.
Thank you. Subcommittee Chair, Ranking Member Lynch, and members of the committee, thank you for the opportunity to testify here today. I'm Mark Hayes, a Senior Policy Analyst with Americans for Financial Reform, which is a coalition of over 200 consumer, community, labor, civil rights, and other organizations that advocate for a financial sector that serves workers, communities, and the real economy, and provides a foundation for advancing racial and economic justice. The cryptocurrency and decentralized finance, or DeFi industries, tout themselves as alternatives to traditional finance that use technology to sidestep intermediaries and offer new ways to build wealth and finance. Unfortunately, the crypto industry is highly volatile, scam-laden, and frequently predatory, which exposes investors to substantial financial losses. In fact, yesterday, the FBI reported that there were $5.6 billion in losses in 2023 alone reported associated with crypto, which was 10% of the cases reported, but 50% of the reported losses. This is largely because the industry often does not comply with or is not subject to the same sorts of investor or market protections found in conventional markets. Many have lost their life savings due to the industry's practices, and people from communities of color and lower-income neighborhoods have particularly been targeted and harmed. Crypto and DeFi must be subject to the same kinds of investor protections and market regulations as other retail investment markets, such as those overseen by the Securities and Exchange Commission and state securities regulators. These rules promote market transparency, price discovery, and market stability, as well as protect investors from fraud and market manipulation. Some of these risks stem from the aggressive promotion of new crypto products, DeFi or CeFi. This often includes celebrity endorsers, sometimes compensated to boost investor interest in assets with little real-world tangible value. Boosters have included marquee figures like Larry David, Gisele Bündchen, and Steph Curry, among many others. The most recent example of this type of promotion is the launch of the crypto venture World Liberty Financial, which has insinuated the involvement of public figures such as the Trump family. Yet, this doesn't work out well for consumers. A Harvard and Indiana University study on such promotional activity found that crypto ventures promoted by influencer tweets slid by 18% within 3 months. The DeFi industry's contention that its technology democratizes finance and makes regulatory standards found in other markets less needed or unnecessary altogether does not hold water. In fact, there is considerable centralization and consolidation of the ownership, control, infrastructure, and economic relationships found in DeFi. As I describe in my written submission, decentralized finance is not all that decentralized. A limited set of powerful players control crucial elements of the DeFi industry. For example, one industry study showed that just 1% of DeFi platforms users control 90% of governance tokens on 10 major DAOs, or decentralized autonomous organizations. And far from automatically creating safety, the technology used has enabled or allowed multiple scams and hacks amounting to, by one industry estimate, $1.5 billion worth of losses in 2023 alone, which is, based on the cases used, more than one scam per day on average. In reality, DeFi is composed of de facto crypto-based intermediaries that play similar roles and pose similar risks as traditional financial markets do, but who aren't covered by or abide by the protections and rules that exist in those markets. And the DeFi industry is replete with these risks and harms: widespread hacks and cyber attacks, extractive and exploitive financial products and services, market manipulation, illicit finance, and more. These problems warrant a proactive regulatory approach to protect investors, crypto markets, and the financial system. But Congress's efforts to advance crypto-related legislation, such as with FIT 21, which passed the House this year, have mostly proposed creating new, lax, custom-made crypto and DeFi regulations or exempting the DeFi industry from existing regulatory oversight altogether. Instead, Congress should work with regulators to use their existing regulatory authorities to protect investors, consumers, and communities from the risks and harms that DeFi presents, and to hold crypto and DeFi actors accountable for complying with existing rules and regulations. Studying this industry may be useful, but it should not preclude action to protect consumers today. I look forward to your questions, and thank you for your time and consideration.
Thank you, Mr. Hayes. We'll now turn to member questions, and I recognize myself for 5 minutes. I spoke earlier about how our regulatory and legal frameworks were designed for a financial system with centralized entities. Because of this, it can be challenging to apply the approach of same risk, same regulation to DeFi due to its permissionless peer-to-peer nature, and I think our witnesses all have done an excellent job talking about those, that concern or opportunity and the costs and benefits. But nothing is without risk. Current rules and regulations were established to address specific risks, and they aren't the same between traditional finance and DeFi. So, Ms. Tuminelli, what are the potential risks regulators should be focused on when they think about DeFi?
Thank you for that question. And as you suggested, the inherent risks in the traditional financial system are related to intermediaries. They're often opaque, we don't know what's going on, and they're often discriminatory or subject to human bias or subjective error. In DeFi, the risks are more related to the actual technology, so like vulnerabilities in code, or consumer protection and education, making sure that people understand what a DeFi protocol does, how a self-hosted wallet works. And of course, illicit finance is a risk in every system. It's just that the way we deal with illicit finance in DeFi has to be different than the way we address that risk.
Right, so you recognize that we've got to solve for that equation, which is how we do the authentication and protect against bad actors in DeFi. Do we have the ability, when you think about it, aren't we very vulnerable from a cyber point of view? I'm not a big CISA fan. I know they have that responsibility, but I think there are a lot of vulnerabilities inside our cyber system in our country, no greater risk than the U.S., which is why I don't support more U.S. databases being created. They're just bigger targets. What's the best way to do that consumer protection from being hacked? Their wallet, their protocol, and I do agree that that's one of the most inherent risks compared to an intermediated risk of a capital failure or an error made by not doing the CrowdStrike patch in your system. So we know those risks, but talk about how you avoid that hack issue if you're in a decentralized finance environment.
So I think as you flagged, there is a big difference between a cybersecurity risk and a risk on the actual blockchain layer with the technology itself. With cybersecurity risks, those are often localized to one person or a small group of identifiable people, and we know what to do with cybersecurity risks. For years, we have been navigating.
We're not very good at it, though, are we?
Well, the industry has created actually a number of crypto ISACs that specialize in this exactly. They jump in if there's an ongoing exploit or hack and try to assist in returning victim funds. But to get to your other point on consumer education and protection, the industry has also come up with solutions for that. And a number of front ends have actually built into the front end software fraud alerts, scam alerts, so that a person can be protected on the front end.
Let me switch, stick with our discussion, but switch over to the commission now. And they proposed a new rule that broadly expands the definition of an exchange. I'd like your views and Mr. Van Valkenburg's too on this, to capture not just decentralized digital asset platforms, but also DeFi. Pretty broad. I was telling Mr. Lynch, things are not very well defined here, and so it seems to be a pretty massive overreach, over-definition by the commission. How should DeFi think about this exchange function? Like, one of the key functions of an exchange and an intermediate system is market making in a bond or a stock to aid in that matching, for pricing purposes. I get both of your points, but I'd like both your comments on this. The Gensler approach, what's wrong with it, and what a better approach is. And you've got 25 seconds, so I'll give you 25 seconds. Go.
So I would say that the very first problem is that the SEC has still never defined what a crypto asset security is, which is a precursor to this entire discussion. With the exchange rulemaking, they have swept extremely broadly to catch developers and protocols that have no ability to comply with the rule as they have proposed.
Very helpful. Mr. Van Valkenburgh.
The only thing I'd add.
Mike.
The only thing I'd add to that excellent answer is the SEC swept so broadly in its Exchange Act rulemaking that it's run right into the First Amendment of the Constitution. And it's not the first time they got slapped down in SEC versus Lowe for being overzealous in their enforcement of the Investment Advisor Act and regulating mere publishers of newsletters. In the Exchange Act, they want to regulate people who, quote, make available a communications protocol. And if making available a protocol, which is a set of rules, isn't publishing speech, then I don't know what is.
Thank you, sir. My time's expired. I turn to the ranking member for his 5 minutes of questions.
Thank you, Mr. Chairman. Mr. Hayes, recently the multi-service crypto platform D.Fi estimated that almost $2 billion in crypto assets on DeFi platforms were lost back in 2023 due to hacks, theft, or exploits based on, they had 448 documented cases, more than a hack per day. And only about 10% of these losses were recovered for investors, according to the report. The nearly $2 billion in DeFi attacks losses in 2023 was dwarfed by the $47 billion that was lost in 2022. So if you look at the traditional finance system, the Bank Secrecy Act, our money laundering protocols, all resulted because we had crises in the industry and we needed to take steps. You can even look at the collapse of the banking industry during the Depression. We lost over 1,000 banks went down, so we had to come in with regulation to say, okay, we're going to have deposit insurance. We created the FDIC. What about this argument that we don't need any intermediaries, and all this theft and fraud continues to occur. What would bad actors benefit from if for say, we don't employ know your customer or anti-money laundering protocols connected to DeFi?
Thank you for the question, Congressman. I think you're right to be concerned. That's a large volume of loss that's affecting consumers who are already engaging in these practices, whether or not we truly understand what DeFi is or whether decentralization has been achieved. And I think the problem goes deeper, and I want to stress there is a focus on the role in which cybersecurity and the technology of these platforms facilitates some of these problems, but arguably there's almost always a human component behind it, and the problems that arise have parallels in our current financial system and the economics of finance, which we already have addressed or at least are addressing with existing regulatory structures today. So for example, many hacks are inside jobs. They're set up by the actual people involved. Rug pulls are ubiquitous, and rug pulls involve insiders that are dictating how code is written and promoting tokens or products that draw in investors with little knowledge of those products. More disclosure, more information, such as the things found in securities regulation, would help those investors have a better understanding of who's behind the products, how they're operating them, what they're offering, what their background is. But that doesn't exist in this space today. White papers are not standardized. People have to read code. It's a real problem. Oracle attacks are manipulation of real-world price data. That's something that goes through DeFi interfaces, but someone designs that interface and determines how the oracle goes in there. And so with money laundering, I think the problem is there's a conundrum. If you allow DeFi to operate without the same consistent KYC controls, money launderers look for gaps in the broader financial system. They're looking for weaknesses. They're looking for lowest common denominator spots that they can exploit. This committee knows full well that some of the anti-money laundering measures that were passed in early 2000s for different financial professionals were just recently, after 20 years, implemented by Treasury because of massive resistance to the industry. That was a massive gap in that framework. So if we allow that gap to continue in DeFi, we're essentially setting a table for money launderers to continue to exploit those gaps in ways that harm lots of people. So there are ways to look at how we can tweak those things, but the bottom line is if those rules aren't consistent, you're going to damage the entire approach to combating illicit finance, and that's going to harm a lot of people.
There's much said about the decentralization in DeFi. Is that actually the case? I mean, we've got studies here that say there's a narrow group of people that actually control this, and it doesn't have the full benefits of decentralization. Is that what you've found?
The research we've seen suggests that, and much of that is industry research or outside observers. I think it raises a question, if decentralization can't be defined and can't be realized, then it can't provide the benefits it offers. So I think before we rush into allowing these actors to sort of have full access to the financial system, particularly if it becomes interconnected with a broader financial system, which is starting to happen, I think we should take a precautionary approach, and that includes regulators reining in some of this activity before it can cause more amplified harm.
Thank you, Mr. Chairman. I yield back.
Gentleman yields back. The gentleman from Oklahoma, Mr. Lucas, is recognized for 5 minutes.
Thank you, Mr. Chairman, for holding this hearing, and thank you to our witnesses for testifying today. First, I think it would be helpful to step back and appreciate where decentralized finance fits into the larger conversation around digital assets, blockchain technology, for that matter, the future of the internet. Ms. Rettig, starting broadly with Web3, could you discuss how blockchain technology enables decentralized digital ownership? And could you highlight some of the use cases beyond DeFi?
Thank you very much for your question, Congressman. As I noted in my oral testimony, DeFi protocols are deployed onto permissionless blockchain networks. So on a network like Ethereum, there are hundreds and thousands of computers that must come into consensus to settle these DeFi transactions. So at the base layer, they're highly decentralized. And at the DeFi application layer, they may be decentralized in a number of ways, but protocols that operate without intermediaries autonomously through software do meet the level of decentralization. On your second part of your question on non-financial use cases, there are a number. About over a year ago, Polygon Labs launched a open source database of blockchain-based use cases called the Value Prop. Today, there are over 500 applications and 43 use cases, and the non-financial use cases outweigh the financial use cases. So two that are most notable are the California DMV has digitized 42 million car titles to smooth the title transfer process. And GeoNet is an application that pulls satellite data in order for farmers to have better predictability about their crops and to be able to enhance predictability.
Mr. Valkenburgh, could you also share your perspective about the impact of decentralizing the internet?
I'd be happy to. Thank you, Congressman. So there's a paradigm shift involved with DeFi, and we keep coming back to it, which is the removal of intermediaries. The cybersecurity threats that we've discussed in the context of the larger internet are a part of that paradigm shift. Hackers today target centralized servers. Centralized servers have wealths of information and data about the users of those services. This doesn't need to be the way the internet is built. Indeed, the original internet was built with individual servers run by individual internet users in mind. You'd have your own blog, you'd speak your own voice, and you'd have censorship resistance, autonomy, and privacy, the core values of the American Revolution. We've seen a change as large companies built services, Facebook, Google, on top of the internet and created moats around their user data. And DeFi, along with the non-financial uses that Ms. Rettig highlighted, is an alternative to that, a return really to the original view of the internet, which is that it should be an open playground for people to build what their heart says they should build and do it themselves and own their own data in the process.
In the remaining time I have, I'd like to focus on an issue that I put a lot of energy in on science and space and technology committees, and that's the future of quantum computing. Quantum computing has enormous untapped potential to solve the world's most complex problems, but also has the ability to wreak havoc in the wrong hands. Cryptography, of course, is the backbone of blockchain networks, which is, in the near future, must withstand a post-quantum world. Ms. Tuminelli, how much attention has been given to post-quantum cryptography in the context of DeFi protocols as we slide into quantum computing?
Thank you for the question. As you suggested, cryptography is the backbone of blockchain technology, which means that it is also the backbone of DeFi technology. So I think exactly as your question said, it is key and central to the future of DeFi.
Because with the potential for quantum computing that exists, I believe, from the hearings we've done on the Science Committee, the effects on these encryptions are going to be dramatic. How do we keep up? Anyone else wish to touch on that for a moment?
The one thing I'd add about quantum computing is it could make a lot of our current crypto systems obsolete in a dangerous way. Now, the interesting things about DeFi here are that we would see in real time the need to update our systems because hacks would become immediately apparent. Large centralized banks, financial services providers, and internet corporations may get hacked and may fail to rapidly disclose those vulnerabilities. So there's something beautiful in the fact that these systems are open and that we immediately see when a vulnerability exists and we can start to patch it. And the value in these systems means there's effectively a very, very good bug bounty to draw people to fix these problems.
Thank you. Yield back, Mr. Chairman.
Gentleman yields back. The gentleman from Illinois, Mr. Foster, Dr. Foster, I should say, is recognized for 5 minutes.
Thank you. I'd like to actually follow up on the chair's discussion about the need to identify bad actors. How is this actually implemented in DeFi right now? First, how do you identify them? In a system where the underlying protocol is that of a permissionless, anonymous, self-hosted custody of assets. How do you identify and how do you effectively ban bad actors, or is there no such concept as bad actors in DeFi? I just go down the line, and if you could describe, how it's implemented, if at all.
Sure, happy to do that. Thank you for the question, Congressman. Our fund actually has invested in a company that is building what's called zero knowledge proof protocols that
Yeah,
allow...
but that's not what's there right now. I understand, and there's a bunch, we had hearings on
Sure.
homomorphic encryption. It's not ready for prime time. And with the technology that exists today, how do you do it?
Well, this particular company has launched a product. It's actually being used in the marketplace now. So they haven't gotten market share at this point, but they are growing significantly.
And there's also fundamental problems with the zero-knowledge proofs. You still need a trusted third party to control their privacy budget on these things. You know, I've looked at the mathematics behind there. I program blockchain, and by the way, Ms. Tuminelli, I appreciate your efforts to educate Congress on this, which is a challenge. And if you ever would like to learn how to program blockchain, I would be happy to teach you. If you go next and say, how do you implement identification and banning of bad actors in an anonymous, self-hosted situation?
Thank you so much for your question, Congressman. I think there are three primary ways that it happens today. First, there's an organization called the Security Alliance, which is an organic group that monitors and works in public-private partnership with law enforcement to watch for hacks and engage in other types of activities.
But when you've identified a bad actor and the bad actor reappears with an anonymous self-hosted wallet, how do you identify the fact that you're a bad actor?
Law enforcement and blockchain analytics tools are actually able to trace a lot of this very transparently. And
A lot isn't enough. You need to be able to trace all of it, and that's, I don't believe, technically possible.
Our current system under the BSA is not 100%, but I think we should be aiming for that in the DeFi ecosystem, and there are a number of ways to handle that. I've actually made one such proposal in a paper that I co-authored, published in January, where we identify a new category called critical communications transmitters that will take on enhanced risk mitigation measures for financial integrity.
Okay, now when you've identified a bad actor, how does DeFi come together to say this is a bad actor, we're going to ban you? How do you even trace that person when people are operating multiple identities anonymously?
Sure, the critical communications transmitters will bring immediate reports to FinCEN. They won't look identical to SARS, but they'll have the type of information that will allow FinCEN and other law enforcement to be able to trace both the immediate wallet you're talking about and anything that emanates out from that as well.
But how do you trace all users of anonymous wallets? If one person's operating 12 anonymous wallets, how does that dealt with in this system?
I can say that through public-private partnerships and working with the FBI and DOJ on a number of these matters, they're actually able to trace wallets very quickly and much more quickly than the decades that it's taken to trace illicit funds in the traditional financial world.
Does that apply to the most deliberately anonymous financial products that have been made, which are made by design very hard? And this rapidly gets into classified stuff, and so if you can't talk about that, that's all right.
I can't talk too deeply about it, but I will say that funds from some of the worst actors are frozen today and unable to be moved, given the immediate identification that has happened both with industry and law enforcement working together on these issues.
And that when you freeze someone's fund, you freeze their activities in every one of the anonymous wallets that they control?
You certainly freeze the illicit activities, the illicit funds that you've identified.
That you've identified, okay. So there is no way to ban a bad actor. They just pop up in some other guise with some other set of self-hosted wallets?
That may be, but
Okay, thank you. There are also questions of governance here. And Mr. Hayes, there's a fundamental guarantee that people who are investing in anything in the regulated markets, in the U.S. at least, that when you invest into something, there isn't a cabal of people secretly controlling what you've just invested in that are going to rip you off. It seems to me that also can't really be a guarantee in a situation where people have anonymous self-hosted wallets that control the voting. Yeah, so how do you view this as a problem, and are there any ways to fix it?
Well, briefly, I think it is a problem. You see concentration of ownership of governance tokens across platforms, particularly with venture capital funds who arguably are dictating how these programs are run, and that's for their benefit, not necessarily other retail investors.
Thank you, and my time is up, and yield back.
Mr. Rose of Tennessee, recognized for 5 minutes.
Thank you, Chairman Hill and Ranking Member Lynch, for holding the hearing today, and thank you to our witnesses for your time in being present today. I'm proud to say that my home state of Tennessee is a leader in blockchain investment thanks to the forward-thinking approach we have taken to regulation. One such example is our recent passage of legislation that allows limited liability companies to register as decentralized autonomous organizations, or DAOs. At the time of the passage, Tennessee was only the second state in the country to have such legislation signed into law. Mr. Avello, could you explain what DAOs are and why they have become so popular?
Happy to. Thank you for the question, Congressman. I think DAOs, if you ask 30 different people, you might get 30 different answers. But the way that I like to think about it kind of starts from this primitive, that there are individuals who are using blockchain technology or leveraging blockchain technology to create a governance system without a centralized management team. And what the same aspects that exist in all these different organizations are a lack of a centralized management team. There are collective decision-making across the groups that are organizing kind of natively on the internet. And typically there's a governance token involved. That's not in every single case, but there's typically governance token rights. As far as why they're becoming popular, I think it's when there is excitement within a group of people that are interested in a different project. Now that can be DeFi, that can be investment clubs, that can be social groups. There's a whole host of kind of activities that people engage in through DAOs. But I think the ease with which they're able to organize initially makes them popular. As far as long-term, they can be, depending on the services that are being offered by the DAO, and they take on a variety of different forms: limited liability companies, different foundations overseas, sometimes there's sometimes groups that operate without entities. So they see the flexibility that's offered through the DAO kind of organization, I think has given rise to its popularity.
Thank you. Ms. Tuminelli, last year the Internal Revenue Service proposed a rule requiring broker reporting of sales and exchanges of digital assets. This rulemaking seemed to be contingent on the assumption that broker businesses are in the position to know a person's potential tax obligation. Is the IRS proposal workable?
Thank you for the question. And in short, no, it is not. The proposed definition of broker is extremely broad. As you said, it puts anybody in a position to know in the place where they have to report. For example, right now, I'm sure members of your office have started fantasy football. At the end of the season, the commissioner of your fantasy football league is in a position to know the winnings or loss of any person who participated. That person would be a broker under the IRS's new rule.
And what is the status of the rulemaking?
So right now, the IRS finalized the part of the rule that applies to others outside of DeFi, and we applaud them for that. They did take the right tack in trying to learn more about DeFi before they finalized the rulemaking as it applies to DeFi.
And Ms. Tuminelli, I think that my colleagues on the other side of the aisle in the Biden-Harris administration scapegoat the digital asset industry as a mechanism to avoid tax liability. How can the DeFi industry support tax compliance?
Sure. So obviously the tax liability for an individual is on the individual themselves. But as an industry, of course, there are software and technology solutions that make it easier for a person to assess their tax liability and pay that tax liability. But ultimately, it's their responsibility as an individual to pay their taxes.
Thank you. Under President Trump, the Financial Crimes and Enforcement Network released guidance in 2019 that has been one of the few regulatory actions that has provided legal clarity for DeFi developers and businesses. However, as I was unsurprised to learn that the Biden-Harris administration's Department of Justice has poured cold water on that guidance and taken a more aggressive enforcement path. Ms. Tuminelli, could you explain what impact that has had on the DeFi industry?
Sure. So as you said, in 2019, FinCEN finalized guidance that was very helpful to the industry and explained what a money services business was in the context of providing and publishing software. And the industry followed that guidance for years. But just this year, the Department of Justice took the position that that guidance is merely a suggestion and that they don't need to comply with it or listen to it. And it's really unfortunate that two entities in the same government are disagreeing on what the law is, and the consequence is a person's liberty.
Thank you, and my time has expired. I yield back.
Gentleman yields back, and we're honored to hear from the ranking member of the full committee, Mrs. Waters, for 5 minutes.
Thank you very much. While decentralized finance, or DeFi, aims to create greater efficiencies and transparency, it can also pose heightened risk of hacks, scams, unequal information, and conflicts of interest that can harm consumers and investors. We've seen this play out in the new DeFi venture that Eric Trump and Donald Trump Jr. plan to launch, called World Liberty Financial. Because of the prominence of those behind the project, bad actors took advantage of the opportunity to scam potential users. Laura Trump and Tiffany Trump's ex accounts were hacked, and scammers used them to announce links to a coin, falsely claiming to represent World Liberty Financial. According to the analysis, at least 200,000 people viewed the posts, and approximately 2,000 people purchased 1.8 million worth of the fake token. Lawmakers have a responsibility here, and I think the lawmakers have a responsibility to consider strong protections to prevent such scams from moving forward. Mr. Hayes, I'd like to ask you a question. opaque DeFi platforms with unclear governance and control mechanisms may create hurdles for regulators to establish responsibility and accountability for regulatory compliance. In launching actions against DeFi entities, regulators like the Securities and Exchange Commission and the Commodity Futures Trading Commission have had to navigate complex legal issues. We've seen these issues play out in litigation involving decentralized autonomous organizations and virtual currency mixers. In your view, how can regulators deal with mass noncompliance by entities that claim they are decentralized to avoid regulatory compliance? What more needs to be done to ensure robust consumer and investor protections in this industry?
Thank you, Congresswoman. The issues you've laid out here are pretty profound, and I think the simplest way to answer your question is that regulators should continue to do what they're doing. So for the example, the Securities and Exchange Commission's rulemaking, looking at the definition of exchange, we've heard some discussion about that today. I think there are a couple of points to keep in mind. The original law that drafted that, the Securities Exchange Act, was meant to be expansive to cover a lot of different scenarios. Far from sort of an antiquated idea, it really was meant to be evergreen. And Congress in the past has considered narrowing that definition and decided against it. So this rulemaking, ironically, provides a certain degree of clarity that looks at the functional nature of how exchanges operate. And what the proposed rulemaking has said, or the rule has really explored, look, if you are matching a buyer and a seller to facilitate a trade, that's an exchange. You can be a regulated exchange under that act. You can be an ATS. You can be a DCM under the CFTC if you're not dealing with securities. There are a couple different pathways. And in fact, I know they're continuing to work on that rulemaking to further clarify what kind of information applies to that. So the SEC is already embarking upon that effort, and we should continue to support their efforts. I think the CFTC has done similar work with the UKI case, where they've identified how there are times and places where DAOs meet the facts and circumstances similar to what you might find with an unincorporated association. So in fact, persons are responsible. And I think legislation that undermines that and makes it harder for regulators to do that is misguided.
Thank you very much. I yield back.
Gentleman yields back. The gentleman from Wisconsin is recognized for 5 minutes.
Thank you very much, Mr. Chairman. Thanks for holding today's hearing. We're just talking about risk. I want to just dive in because I think there's some real strong counterpoints that we need to make sure are on the record, right? With every new technology, there's benefits, there's risks. How do you manage the benefits? How do you scale down the risks? If I can, I want to come to you, Ms. Rebecca Rettig. DeFi shows promise. There's also some risks that needs to be addressed. DeFi hacks cost more than $3.6 billion in 2022, and the number's likely gone up since. Can you talk about what DeFi protocols and the broader community have done to address these risks, and what else may need to be done to target existing vulnerabilities? Because I think it's really important to talk, sure, there's risk out here, but how are we working to downsize that risk?
Great. Thank you very much for your question, Congressman. And I think we can all agree that any of the hacks or scams or any of the risks should be mitigated as thoroughly as possible. Say that the three primary risks in DeFi are cyber risk, system management risk, as well as usage risk. There are current efforts to combat many of those. As I mentioned previously, the Security Alliance looks at all of those types of risks, both what's happening from an illicit finance perspective, but also training developers how to build safer ecosystems in general, as well as how to put in place appropriate system management controls to ensure that there aren't these centralized places of data or other areas of vulnerabilities. So that's one of the primary places that it happens, but there is also significant public-private partnership with law enforcement going on in the industry to ensure that a lot of these risks are addressed.
That's helpful. Let me jump over to you, if I can, Mr. Brian Avello. In written testimony, you noted that many DeFi participants are having trouble navigating the jargon and code associated with DeFi projects. On top of that, you argue that many projects fail to present fulsome information. What can market participants do to ensure counterparty communications and disclosure are better understood?
Sure, I think, and thank you for the question, Congressman. I think you'll see a lot of the most notable projects in DeFi have developed, kind of almost as custom, disclosing massive amounts of information, not only on tokenomics with regard to each project, but also at a very granular level, discussing and explaining in plain English how these different technologies work, specifically different smart contract functions if one or more persons is interacting with a contract, exactly what you will be engaging in by interacting with those protocols.
So what should regulators be looking at and considering with respect to rules required around disclosures or other communications?
I think there has to be a lot of interaction with the industry. Probably the most notable or largest projects that have a presence and are actually coming here to engage in Washington would be a good starting point. And then you look at, I think I highlighted in my written testimony what I, as a user and an investor in this space, would expect to see. And I think, frankly, it's a matter of making the information as simple and as clear as possible for the users who are using it, so that you do away as best as possible with the lack of confusion.
Thank you very much. I'm going to come back to you, if I can, Ms. Rebecca Rettig. Shifting gears here, because I think it's worthwhile talking about use cases I know Polygon Labs maintains a database of DeFi use cases. Commissioner Peirce wrote the following: stagnation, centralization, expatriation, and extinction are the words of this release. Today's commission treats its basic approach to exchange regulation as something that must not, indeed cannot, be altered to allow room for new technologies or for new ways of doing business. Strong words from a sitting SEC commissioner. But I think what Commissioner Peirce is actually touching on is a point that we've made many times at this committee, that laws and regulations need to evolve to accommodate innovation safely. So we're talking about the risk up front. We know that there's use cases out there. Can you just comment on some of the use cases that you're seeing that American families and workers would benefit from this?
Thank you very much for your question, Congressman. And the use case aspect is something that really brought me to Web3. I talked about some of the non-financial use cases, but others that abound in the DeFi context, as we're talking about today, is faster payments, which allow for humanitarian aid transfer from the United States to those on the front lines in Venezuela. There are health workers there who've needed it. There's been also payments in the humanitarian aid context for the efforts for Ukraine, both from people in the United States as well as outside this country as well. And some of the other types of efficiencies that we've seen have been for the exchanging of assets and the like.
Thank you very much. Thank you all for your testimony. Mr. Chairman, I yield back.
Gentleman yields back. The gentleman, Mr. Caston, is recognized for 5 minutes.
Thank you, Mr. Chair. Thanks to all for being here. I remember when I got out of college, I was living in Boston when I was in my 20s, mostly just reading the Federalist Papers. But I remember there was this great pizza restaurant over on Commonwealth Avenue by BU that rather famously the pizza was fantastic, to be clear. They were found to have basically retained virtually every law firm in Boston, and they would hire young lawyers to go make deposits at banks that were often just below the levels that would trigger AML requirements, but if they were above, the FBI office was full of pictures of young aspiring lawyers whose firms had all been completely conflicted out of ever working against the owners of said pizza restaurant. Nobody would have ever argued that the beneficial use case for this particular pizza restaurant meant that we should never regulate pizza restaurants under AML protocols. And I get concerned in this DeFi conversation that we're framing this as it's beneficial use. It's really good. It's maybe as good as the pizza that was at this pizza joint. And therefore, we shouldn't have anti-money laundering rules. Like, that doesn't make any sense to me. Mr. Hayes, you'd mentioned the UkiDAO case where my understanding is that UkiDAO was actually advertising that that you could get around AML laws, and CFTC has come after them, had alleged that they were actually created with the explicit goal of operating an illegal trap form. So I guess, Mr. Van Valkenburgh and Mr. Tuminelli, I'm just curious, yes or no, because I don't want to misunderstand your testimony. Is it your argument that if a DeFi protocol is found to be violating anti-money laundering rules, should there be any legal accountability to the creators, the operators, the people maintaining that service? Just yes or no. Should those people have any legal liability?
Those who are not decentralized, those who are custodial, have AML laws that apply, and they should be applied, and they should be enforced.
If it's a
against.
DeFi protocol, are you saying that there should, we're saying it's decentralized?
An immutable smart contract that I transact with?
I'm just asking yes or no. Should they have
As an
somebody write the
American,
code?
as an American transacting with a mutable smart contract, I'm transacting with my own funds. I should not be subject to the Bank Secrecy
Okay, so
Act.
you think no, Ms. Tuminelli, you think yes or no? Should there be any liability that's there?
I think bad actors should be held liable for the bad conduct that they engage in. Not the developers, not the people who created the software. It's the bad actors who actually committed the crime. We should go after
So
them.
there should be no liability for the people who created the tool. So back to my pizza example. The people made the pizza joint. They used these laws. There should be no liability for them because they're just pizza. They're just pizza producers.
If I make a neutral tool that somebody uses to
Okay,
commit crime, I should not be held responsible for that person's conduct.
Okay, Mr. Hayes, that's bizarre. I mean, that's aiding and abetting commission of a felony. Mr. Hayes, who do you think should be held liable in those cases? Is it the DAO members? Is it the creators? Is it where should that liability lie?
I think it's a good question. It's complex, but I think you can apply existing laws to find some answers. I think it also depends on the facts and circumstances of those cases. But I think what you're raising raises a conundrum. Developers and admins intervene in the platforms that facilitate these transactions on a fairly regular basis, either directly or indirectly through the functions of the DAO. They update the code, they issue assets, they help determine how the validation process works. There are many times when interventions happen by individuals with knowledge. Those include people outside of the developer team and inside the developer team. And it's tricky because why are they intervening in those moments when not only are those about the infrastructural operation of the platform, but actually what the platform does, which is to facilitate transactions and move assets. Why then should they not be held accountable if the transactions that they help facilitate end up facilitating illicit finance? So I would argue that you have to find a way to hold developers accountable to some degree, and the question is, where do you draw that line?
Okay, so I want to get back, because I think we talk about this technology as being unique and not recognizing that we have, to your point, we have these tools. If I buy a security on NASDAQ, I have to disclose, and NASDAQ has clearing offices, and they verify the identity, and I guess, Ms. Rettig, coming to you, following on your exchange with Mr. Foster, in the case of a NASDAQ transaction, there is a clear custody title that is clear. There is no way to participate in that as an anonymous actor. Is there any reason why we could not insist on those rules for DeFi protocols? And if you want to be anonymous, if you want to think you can duck rules, fine, you can't play in the sandbox.
I think it goes to what Mr. Van Valkenburgh talked about in his oral testimony, which would be importing intermediaries into disintermediated systems, which will put the U.S. at a large-scale disadvantage from a long-term perspective.
Look, I'm out of time, but there is no disadvantage to the U.S. economy of not protecting the interests of child traffickers, money launderers, and the North Korean nuclear system.
The one point on your pizza example is that the pizza restaurant had individuals who were acting with scienter. And that's very different than what's going on here.
Gentleman's time has expired.
Yield back.
The gentleman from Nebraska, Mr. Flood's recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you for holding this hearing today. I'd like to maybe just explain my thinking on this topic. I know there's been some discussion of the way DeFi could change finance, But in my view, the largest implications of DeFi are unrelated to the financial applications. Smart contracts could change things that have nothing to do with speculating on assets or currency. It's the technology we're talking about, not trading or wallets, that could really change the world. This leads me to what's called Web 3.0. I am fascinated by how a decentralized web could change the applications that we use every day. If we have a decentralized web, it would disempower the big tech intermediaries that wield so much influence today. I'd like to demonstrate what I mean by an example. If you're a creator of videos, right now you're probably using YouTube to get your videos out there. Now, if you're putting your videos on YouTube, then your income stream is beholden to the rules that YouTube has regarding how much ad revenue they share with their creators. Everything flows through a centralized intermediary between the creator and the revenue generated from the audience. What a decentralized web would do is cut out that intermediary. The creator, as I understand it, would own what they create, and they'd keep the lion's share of that value that their creation brings. That would have to be beholden to the terms of a corporate third party hosting their work. They wouldn't have to be beholden. The infrastructure of the platform itself would guarantee they are compensated directly for the value they bring. Ms. Rettig, I know Polygon Labs is involved with some Web 3.0 projects. Can you talk a little bit about those projects and your thoughts more broadly on a decentralized web?
Sure. Thank you very much for the question, Congressman. Polygon Labs builds the networks on which all of these Web3 applications are built. And those types of applications abound, including both in the financial context and otherwise. One of the use cases we didn't talk about, but you touched upon, is the idea of creation and the ability to hold your own IP, not just your own assets or your own data, although that's critically important. And so those types of creator platforms, including social media, it really returns ownership back to individuals, and that's one of the great benefits of a decentralized web.
Just continuing with you for a second here, do you have any sense of how far along we are to a potential decentralized web, and at what point do you envision we'd see decentralized web solutions more broadly offered for consumers, like consumers of social media and other applications?
Sure. I'd say that the internet has been around for 40 or 50 years, and that we're probably not even 25% of the way into that for Web3, but very far along and moving at an exponentially rapid pace.
Ms. Rettig, do you have any thoughts? You know, I guess I got to back up. My background is in media, and I've thought a lot about how a decentralized web could change traditional print media, broadcast media, and how we consume the news more broadly. And right now, newspapers are going out of business across the nation, and as a result, fewer journalists are watching the school board and all of these different political subdivisions. Do you have any thoughts on this topic?
Thanks very much for your question. I do think that a decentralized web or Web3 applications is changing the way that we consume information. It's coming a lot more organically from individuals who are witnessing the news in a way and able to bring it onto the web in an immutable context, and also to crowdsource information in a way that traditional media may not be able to right now.
I appreciate that. It can be challenging, I think, to forecast what the great next innovations are going to be. I'm excited about what this is. I see a world of opportunity for America. I see us as the one country that can harness this like we did the internet, and with the right protections for consumers and safety and internet sex trafficking and all those things, we should lead the world in blockchain. Now, candidly, I don't know if the blockchain is the technology that's going to bring this to bear, but plenty of smart people do think blockchain is our next transformational technology. One of the things that the chairman and I really agree on is that there is so much innovation opportunity for America if we harness this technology in the right way, protect our citizens, protect the vulnerable. I just hope that as Congress continues down this path, we don't suffocate innovation in a way that lets another country or series of countries have an advantage over what should be an American opportunity. With that, Mr. Chairman, I yield back.
Gentleman yields back. The gentleman from North Carolina, Mr. Nichols, recognized for 5 minutes.
Thank you, Chairman Hill, for holding this hearing. Thanks to our witnesses. Decentralized finance, or DeFi, has transformative potential. It can make our financial system more accessible, transparent, efficient, and innovative. DeFi can create a more inclusive financial system, as traditional finance just might not be for everyone. Of course, as with any new technology, there are risks. I hope we can learn more about how to mitigate those risks during today's hearing. It's important that DeFi remains a bipartisan issue. I'd urge my colleagues to find common ground in supporting both innovation and consumer protection in DeFi. Bipartisan work is absolutely crucial to creating a balanced and durable legislation that will protect consumers and keep digital innovation in the United States. And frankly, I just don't think it's an either or. I think we can do all of these things. We can protect consumers, we can encourage digital innovation, we can embrace this amazing new transformative technology that can improve the lives for so many Americans. We got to keep those jobs here in the United States. Ms. Rettig, first question for you. Can you talk about some of the risks with DeFi and how legislators on this committee should be thinking about how to address them?
Thanks very much for your question, Congressman, and for your leadership in this emerging space. I'll hit on the illicit finance side of the risks because I know that is the greatest concern, and I think a place, to your point, where bipartisan and industry can all agree that we want that to stop, not a penny should go to bad actors. And I proposed a framework along with my co-authors in a paper that came out in January that looked at how to combat illicit finance in DeFi with a three-part framework. The first was to expand on the definition of independent control found in the 2019 FinCEN guidance to be able to actually identify intermediaries that exist who may actually have regulatory obligations. So it will close the gap that the DeFi Treasury illicit finance risk assessment put forward in DeFi. The second part is what I alluded to in my testimony, which is to treat pure technology protocols as critical infrastructure, just like we do with electronic clearing systems and financial messaging systems. And the third part is to create a new category of entities that will have additional risk mitigation obligations in the financial integrity space to be able to meet the goals under the BSA of document detection and deterrence of bad actors.
Thanks so much. Second question to you again. How are other jurisdictions approaching the regulation of DeFi? And is the U.S. falling behind countries like China?
Thank you very much for your question. And unfortunately, we are falling far behind, and setting China aside, we're falling behind the rest of the world. Just from a anecdotal perspective, regulators across the world have actually been engaging with industry for, I would say, the last 5 or 6 years to talk about what to do in a collaborative way. The EU in particular, the UK as well, and numerous countries in Asia, Japan, Singapore, and the like. Every single country to date has, even if they've implemented centralized crypto regulation, they have said we either need to study or explore or do further analysis of DeFi. And I will say the one notable proposal is from France's prudential regulators, which seek to think about regulating DeFi much like cyber infrastructure and imposing certain types of cybersecurity standards and audits of these DeFi protocols. So it is very different everywhere across the world than how we are handling it in the US, other than in some of the proposed legislation we've seen, all of which suggests studying DeFi, which is the right way forward.
Thanks so much. You know, we did a bipartisan CODEL. We travel around the world to meet with these other markets. They're open for business. They are trying to take jobs here from the U.S. And it certainly dawned on me the importance of making sure we continue to keep up with the rest of the world, because this is a place where we continue to fall behind unless we act here in Congress, and we have the ability to do that. So I'm eternally optimistic that we can get it done. Mr. Avello, next question to you. We constantly hear that both innovators and capital are leaving the U.S. due to a lack of regulatory clarity. What human capital and financing trends are you seeing in the U.S., seeing as the U.S. falls behind in Web3 and DeFi?
I can say from wearing my investor hat and from a personal perspective, I've seen a number of incredibly qualified teams, the exact types of people I think that you were mentioning that you'd want to see here, building hundreds of millions or multi-billion-dollar companies and protocols. Unfortunately, having to move abroad necessarily to set up operations, their companies, and basically offshoring most of their activity. And I can tell you from working with or seeing pitches from teams like this that there is an incredible interest about staying here in the United States and potentially launching and operating their protocols in a compliant fashion. But I think the regulatory unknowns are just too challenging on a personal level, and unfortunately they've had to move abroad in order to effectuate their businesses.
Thanks so much. I'm out of time. I yield back.
Gentleman yields back. The distinguished gentleman from Ohio, the vice chairman of our Digital Assets Subcommittee, Mr. Davidson, is recognized for 5 minutes.
Thank you, Chairman. I thank our colleagues and the panel for your testimony today. DeFi is an essential component for a vibrant financial sector in the United States. We've dominated markets around the world, and it would seem particularly foolish to change course now. That's what we're at the risk of. I mean, as I listen to some of my colleagues, I really appreciate Mr. Nickel for highlighting that this is an issue that largely unites Republicans, and it does divide Democrats. Most of the panel we've seen from Democrats today, though, has been insane. I mean, we basically, if they were applying their same logic, I guess, think how many crimes Google becomes an accomplice for because people do searches or use the maps function to navigate to the place they're going to commit crimes. Thankfully, I mean, they are targeting speech in other ways. Thankfully, I haven't seen them make that ridiculous level of an argument yet. But Mr. Van Valkenburgh, you're highlighting that code is speech. And, you know, one of the things that is at the core here is another thing, privacy. The idea of you would think when I hear Mr. Foster talk about the government granting permission for you to do something, that the government is the grantor of our rights. But thankfully in America, our founders recognized that rights come from our Creator, that among them are life, liberty, and the pursuit of happiness. And the First Amendment is a limitation on the government's ability to infringe on your right to speech. And the Fourth Amendment is a limitation on the government's ability to infringe on your right to privacy. And DeFi, I think, how in the world can you have decentralized finance without the decentralized part? They want a central hub that is the grantor of permission, the filterer of speech, the filterer of privacy, the grantor of permission. Now, you could expect that in a police state. You could expect that in an authoritarian country controlled by the Chinese Communist Party or something like that. But why in the world would we see our colleagues here in Congress, where we're sworn an oath to support and defend our Constitution, would you see people advocating for that? So, Mr. Van Valkenburgh, could you pick up, I know you wanted to say a bit about this speech angle and perhaps more.
So what Member Foster suggested, where the problem with anonymity is that we don't have 100% identification and control over financial transactions in the economy, I don't think we'll have 100% identity and control over DeFi transactions, and I think we will have robust anonymity, and that's an American constitutional right. So you have a constitutional right to anonymous transactions that support organizations and causes that defend against discrimination and violations of our constitutional rights. We fought about this during the Civil Rights Movement in the 1970s. As Thurgood Marshall said with respect to the Bank Secrecy Act, the law that actually requires financial surveillance of custodial intermediaries, though not non-custodial intermediaries, Marshall dissented from the constitutionality of even that level of surveillance. He said, "The fact that some may use negotiable instruments for illegal purposes cannot justify the government's running roughshod over the First Amendment rights of the hundreds of lawful yet controversial organizations like the ACLU. Congress may well be correct in concluding that law enforcement would be facilitated by the dragnet requirements of the Bank Secrecy Act, but those who wrote our Constitution recognized more important values."
Thank you for that, and great insight. I hope we can go after that and third-party doctrine again in some other venues. But as it relates to DeFi, Ms. Rettig, you've done a great job of highlighting how privacy is an inherent part of the reason people would choose to conduct transactions. It has to be protected for it to function. But the other part is, for somebody to surveil your transaction, most of these companies are charging a fee for service. And look, I mean, I appreciate what Visa and MasterCard and American Express, I have one of each of those, or perhaps more, they do. They check and make sure it really is me and I'm buying from somebody else. And if it wasn't me, they provide a hedge. And for that, I know I'm kind of comforted that there's an intermediary. Now, I'll admit I'm a little creeped out when the government wants to mandate that they surveil me and hand over my transaction data without a warrant or a subpoena. That's a lot more government than I want. But for other transactions, I still carry cash, and I like that there's no intermediary. And I know that once I gave the cash to somebody, my ability to reclaim that is more limited. It doesn't mean I have no recourse. How do you make DeFi function if you don't have privacy?
Thank you very much for your question, Congressman. I think DeFi, as Mr. Van Valkenburgh said, will have at least pseudonymity, right? A privacy over who you are and certain types of information in that regard. I think to your point on Visa and MasterCard, we agree that not only the people who can access those aren't the only people who should be able to access the economy, right? Goldman Sachs and their clients aren't the only people who can participate in the American economy. And so DeFi and the larger Web3 movement is meant to expand and democratize that even more greatly.
Thank you for that, and may God bless you all with great success in spite of some of my colleagues' efforts to undermine it. I yield back.
The gentleman yields back. The gentleman from California, Mr. Sherman's recognized for 5 minutes.
What we have here is an effort to liberate billionaires from income taxation. Every time a billionaire successfully cheats on his taxes, a member of the Freedom Caucus earns his wings. Billionaires can't keep anonymous with $100 bills because their pockets aren't that big. And the decision our country has made not to print a $500 bill or a $1,000 bill means that the use of cash becomes less in terms of the amount of cash in a single bill declines by 3 or 4 percentage points, 2 or 3 percentage points over the last 5 or 10 decades. Now, we're trying to create a market here for a system that is much worse than the system we have for honest people. If you have crypto, you can go to Coinbase or a similar broker, put it up, and get a loan at margin rates that are similar to what you do if you have stocks or bonds that you're borrowing against. This system is going to be more expensive, but it's much better for drug dealers, much better for human traffickers, much better for sanctions evaders, which is why Putin and Iran have embraced crypto and unhosted wallets. But the real market here is tax evasion. Trump's IRS commissioner testified, we got $1 trillion a year of uncollected taxes. That's $3 trillion of unreported income every year. That's $30 trillion of unreported assets every decade. So the question is, why would somebody use a less efficient system? And the answer is, if you're a patriotic anarchist and you agree that we should have a powerful America, but only wage earners should pay the income tax, and it should be voluntary for those in business and investment, then you design a system in which know your customer is optional, and in which those who wish to cheat, whether it be because they're cheating our sanctions laws or our income tax laws, have an efficient system to do so. Now, the other aspect of this DeFi is whether it's a security. We apply the Howey test. Mr. Hayes, if you have a system where you put your money up and you have somebody else manage it and loan it out for you, and then you get a return based on the results. In effect, if you have the Howey case, but instead of oranges, you have crypto, is that a security?
Thank you, Congressman. The Howey test is designed to answer the question you've just raised, and it's designed to be tested broadly to apply to lots of different facts and circumstances. And so I'd argue it's an applicable test to this situation. And there are many instances where crypto securities, whether issued on CeFi platforms or DeFi platforms, meet that test. And to be clear, a platform doesn't have to be issuing or facilitating the transfer of those assets. They don't all have to be securities. There's just have to be a number of them that meet the test for an exchange to meet the terms and conditions obligations of a securities exchange. So I think there are many instances where the Howey test is an appropriate tool and provides a useful answer in this regard.
I would just reiterate that those who talk about privacy for billionaire tax evaders are waging a war against economic democracy in this country, but also creating a corrosive system in which at the country clubs and wherever billionaires meet, it will be thought to be stupid to pay income taxes when there's a whole system of finance that allows you to hide your assets while buying your yacht. And what worries me is not just those who are the tip of the spear who will be the first to evade our income taxes and our laws against sanctions evasion and our laws against drug dealing, and I've seen this happen in a number of other countries. I've studied tax enforcement in a number of other countries. Once it becomes a feeling among a subculture or an economic class that only the suckers are paying their taxes, we create a system in which no billionaire will feel right paying their taxes. After all, nobody else at the country club does it. Wages will be taxed. You get a W-2 form, and the question is whether anybody else. You can make a lot of money by making sure billionaires don't have to pay their taxes. I yield back.
Gentleman yields back. The gentleman from South Carolina, Mr. Timmons, is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to all our witnesses for being here today. Decentralized finance is an incredible advancement in financial technology. At its core, DeFi leverages blockchain technology and smart contracts to create an open, transparent, and accessible financial ecosystem. This means that anyone, anywhere in the world can access services like lending, borrowing, and trading without relying on centralized authorities. However, along with the many promising use cases come many questions about the government's role in this burgeoning space. As a Congress, we have yet to fully acknowledge, understand, and address this technology, causing our country to fall short of our innovative values. Mr. Van Valkenburgh, given the unique nature of DeFi protocols, it is clear that incorporating DeFi into the U.S. regulatory perimeter is a complex endeavor. While we have already touched on some, are there other challenges that the U.S. oversight mechanisms and regulatory structures face as these emerging financial systems increasingly come into orbit?
Thank you for the question, Congressman. So why don't we stay on the subject of tax, because Member Sherman brought it up. So tax evasion is a crime. It should be aggressively policed. Those who don't pay their taxes should suffer consequences in this country. I do not, however, think that tax evasion and its existence warrants a 100% surveilled and controlled financial system. So a difficult area in the cryptocurrency space has been getting clear tax guidance from the IRS on how Americans can pay their taxes when they earn capital gains or perhaps their wages on these networks.
I didn't hear his question or his argument. I mean, it's an open ledger, it's publicly accessible. How would you evade something that the world can see? How can you avoid taxes on an open ledger?
It is in fact more difficult to evade taxes when you're using open blockchain networks than using the legacy financial system, which is happy to open shell accounts for you all over the world. I would also add that the IRS has been very, very late in offering clear guidance, and they are the big part of the problem here. They should have offered guidance on brokers who need to file third-party tax documentation and reports long ago using existing congressional authority. Coinbase is a custodial broker, if you will, of cryptocurrency for tax purposes and should be doing third-party tax reporting to ensure that Americans are paying their taxes and the IRS is getting their revenue. There was no need to change the laws to tell Coinbase that they're a broker. The IRS simply hadn't made that rule change. Eventually, Congress rightly decided to direct the IRS to change those rules with the Infrastructure Act. In that process, they explicitly said, IRS, you need to give third-party tax reporters in the crypto space the guidance they need so that Americans will pay their taxes. Even after Congress directed the IRS went on a multi-year rulemaking spree where they ultimately tried to even apply these rules to non-custodial intermediaries apart from Coinbase in an effort that will not work and will trample our constitutional rights.
We can agree that the government is not helping this process. One more question. While Treasury and the SEC have made regulation by enforcement the dominant theme of the Biden administration's approach to DeFi, we've seen some foreign jurisdictions, such as the EU, take a different approach to the space. Ms. Rettig, I'm curious if there are frameworks in place in other jurisdictions that the United States can draw from as it contemplates how to approach establishing protections around DeFi, and what did these foreign regulatory approaches get right, and what can we learn from them?
Thank you so much for your question, Congressman. I think the foreign jurisdictions have moved forward with centralized crypto regulation and given clear guidance to centralized actors in the space. Governments all over the world have uniformly taken the approach to study DeFi more. There are also regulators who've actually experimented with DeFi themselves and conducted transactions. And there are some regulators who themselves have looked at DeFi protocols as cyber or technology that should be reviewed from a cyber perspective in order to accomplish policy goals in that way.
Thank you for that. I think we can all agree that this is the future of technology. There's going to be disruption associated with it, but we need to lead the way and not have the enormous amounts of resources invested in what is indeed the future go offshore. When the U.S. economy is no longer the best place to start a business, we will lose long-term. And so I would just say that that's something we need to focus on, and there's balance in this approach, but we need to be intentional about it and not fall behind. And with that, Mr. Chairman, I yield back.
Gentleman from South Carolina yields back. I want to thank our panel for your excellent testimony today, for participating in our hearing. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to each of you for your response. I ask each of you to please respond as promptly as you are able. This hearing is adjourned.